Welcome to the deep dive. Right now, if you're in the C-suite, there's this really fundamental question bubbling up.
Mm.
Where's the sustainable growth going to come from?
Yeah, it's a big one. The old reliables. Well, they're not so reliable anymore, are they?
Exactly. Recurring software revenue. It feels increasingly vulnerable, with AI commoditizing features left and right.
And venture capital. Definitely a tighter environment. Plus, things like grant funding, often critical for deep R&D, can be just painfully slow.
You can feel that tension in boardrooms, can't you? These growth engines that everyone relied on. They're sputtering a bit.
You really are. Generative AI isn't just some add-on feature. It's changing the core value proposition for a lot of SaaS players. And investors, the LPs. They're looking for safer harbors, understandably.
Which brings us to why we're here today.
Mm-hmm.
Our mission for this deep dive is to really explore some new frameworks, new architectures that let you leverage what you already have, physical assets, IP,
Right, the existing stuff.
to create cash flows that are, well, more robust, self-reinforcing even, and crucially, not totally dependent on those challenged traditional models.
We're talking about finding realistic paths to growth, paths that make sense for executives navigating this new reality, a post-GPT reality, really.
We've zeroed in on 3 alternative models that we think offer some really interesting blueprints.
Yeah, 3 distinct ways to think differently.
So first, we'll dig into something we're calling dead infrastructure, living margins. It kind of flips the script on getting value from physical assets.
Then there's the Glycan Protocol. Super fascinating idea about turning biological discovery into more of a continuous engine.
And finally, we tackled that long-term innovation problem with exit is a myth, thinking about perpetual R&D vehicles.
And the key thing across all 3 is that they offer, practical ways forward, paths from concept to cash flow, without just hoping for the next VC round or software renewal bump. It's about unlocking value differently.
Okay, let's unpack that first one. Dead infrastructure, living margins. The strategic question here, I guess, is how do you generate real wealth from existing physical systems when everyone seems focused on digital scale?
Right, because the old playbook was just sell more software related to the physical thing, wasn't it? Layer on digital services.
Yeah, dashboards, analytics.
Exactly. But like you said, AI is commoditizing a lot of that. That digital advantage, it's shrinking. So the new game, we think, is about guaranteeing actual tangible performance, uptime.
Okay, so how does that work? What's the architecture look like?
Well, the foundation is something called asset fractionalization. Get this. You take a portfolio of physical assets, say 500 port cranes.
Okay, big, expensive things.
Right. Instead of just this big capital expense line item, you break down the future revenue from their operation into like fractional units. Investors can buy these units, think solar power purchase agreements, but for crane uptime.
Huh, so you're selling future productivity upfront.
You got it. Unlocks capital immediately. Then, tied to that is the idea of perpetual uptime contracts.
Perpetual, not annual renewals.
Forget annual renewals. We're talking long-term deals, 15 years, maybe even truly perpetual, where the payment is directly linked to the hours those cranes are working flawlessly. If they're down, revenue stops. Simple as that.
Wow, okay. That puts enormous pressure on keeping things running. How do you actually deliver that kind of reliability?
That's where the tech comes in. You need a really sophisticated predictive maintenance backbone, and this is heavily AI-driven.
Makes sense.
The AI monitors everything, predicts failures before they happen, schedules the optimal downtime for maintenance. It even prices the risk of things going wrong. This isn't just nice-to-have analytics. It's the core operational engine. It becomes your competitive moat. Trying to do this without top-tier AI, good luck.
So AI isn't just analyzing data. It's actively enabling this whole new business model. What about the investors? What's the return look like for them?
Well, the cash flow from these contracts. It starts to look a lot like stable utility dividends. Predictable, long-duration yield.
Tied to real assets.
Tied to tangible infrastructure, exactly. So it's got some inherent inflation resistance, and it's decoupled from that SaaS churn volatility everyone's worried about.
Okay, so let's break down the value. For a CFO, it's predictable yield instead of lumpy CapEx, right?
Precisely. For a COO, maintenance suddenly shifts from being just a cost center to a strategic lever, a way to guarantee revenue.
And for investors,
Right.
defensible, tangible asset class, different from software multiples.
Absolutely. Can I give you a quick example?
Please.
Okay. Picture a big coastal logistics hub.
Yeah.
They run 120 automated cranes. Historically, maybe they average 6% downtime. That sounds small, but it might cost them, say, $24 million a year in lost throughput. Real money.
Yeah, absolutely.
Now imagine they adopt this model. They sell, say, 60% of the future revenue rights for those cranes to a consortium of pension funds.
Okay, getting upfront cash.
Right. Then they bring in a partner, let's call them Health AI, who installs their predictive maintenance system and guarantees 99.5% uptime.
Big jump. What happens then?
Downtime craters drops to 0.5%. That frees up something like $22 million in throughput they were losing before. The pension funds, they get a nice, steady, maybe 11% yield.
Transport.
They got that upfront capital, maybe for expansion without taking on debt. And critically, the entire operational mindset shifts. Everyone is focused on maximizing minutes online for every single crane. It changes the whole dynamic.
That's a powerful illustration. Really unlocking value that was just sitting there latent in the system. Okay, let's shift gears to model number 2, the Glycan Protocol. The big question here seems even more fundamental. What if biology isn't just about making products, but is actually a programmable economy?
Exactly. It's a mind bender, isn't it? The traditional biotech path, finding a single drug candidate, then the long, risky slog through trials and FDA.
Years and years, huge expense.
Huge expense, high failure rate. And increasingly, the bottleneck isn't just finding molecules. It's making sense of the massive amounts of biological data we can generate. The computational analysis part is key.
So where do glycans fit into this protocol? What are they?
Well, glycans are complex sugars, but think of them alongside lipids, microproteomes. These are complex biomolecules that hold vast amounts of information about biological states, but they've been relatively underexplored compared to DNA or standard proteins. They're like hidden therapeutic clues.
Okay.
So the Glycan Protocol envisions a new kind of operational setup, a private molecule mining network. Think of it like a swarm of AI labs constantly running in the cloud, probing these complex molecular spaces, generating and testing hypotheses nonstop.
So it's not about finding one magic bullet, but creating a continuous stream of potential leads.
Precisely. And pharma companies engage differently. Instead of buying like a massive raw data dump they have to sift through.
Which can be overwhelming.
Totally. Instead, they license access to real-time insight streams. They're subscribing to a flow of validated leads, promising targets coming out of this network. And payment is often tied to the quality, the potential of those leads.
That sounds like it could massively de-risk the early R&D stages for pharma. How do you fund something like this continuous network? It's not a typical startup.
No. And the funding is different too, often through hedge-backed vehicles. Investors aren't betting on one specific drug hitting the jackpot. They're betting on the overall predictive power and efficiency of the discovery engine itself. It's a portfolio approach, a different risk profile than standard biotech VC.
And I imagine the system gets smarter over time.
Oh, absolutely. It's a continuous improvement flywheel. Every discovery, every validated target feeds back into the algorithms. They learn, they get better at predicting, which makes the insight stream more valuable and increases the switching costs for the pharma partners who rely on it.
Okay, so let's recap the value proposition. For R&D heads in pharma, it's outsourcing some of that risky early-stage work, getting a flow of pre-vetted targets.
Right. For the finance chiefs, you're moving away from these huge, high-risk bets on single candidates towards more metered spending that's linked to actual pipeline quality.
And investors get exposure to the upside across potentially many therapies without waiting a decade for an FDA decision.
Exactly. Residual exposure without the binary all-or-nothing risk of a single drug trial. Want an example here, too.
Let's hear it.
Okay. Big multinational pharma firm. Let's say they spend $300 million a year on early-stage oncology R&D. Historically, maybe less than 6% of those efforts lead to a marketed drug.
Pretty typical odds, sadly.
Right. Now, what if they subscribe to a Glycan Protocol network? Maybe it costs them $40 million a year, plus, say, a small 2% downstream royalty on anything that makes it to market eventually.
Okay, significantly less upfront spend. What's the potential return?
Well, in year one, maybe they get 80 really high confidence targets spat out by the network, and they feel confident enough to advance 14 of those into serious lead optimization. That could literally triple their historical pace of advancing compounds.
Wow. So pipeline value goes way up even though the initial budget went down?
Precisely. And the network itself, it builds this recurring revenue stream that's ultimately tied to the real-world success of the drugs it helped discover. It aligns incentives beautifully.
A really fundamental shift in the discovery paradigm. Okay, model 3. Exit is a myth. This tackles a really thorny issue, doesn't it? The startup world loves quick exits, but what about technologies that need decades.
Yeah, this is critical for deep tech. Think advanced defense systems, next-gen space propulsion, quantum encryption. These things don't fit neatly into a venture capital fund's 5 to 7 year horizon for liquidity.
Right? VCs need an exit strategy, an IPO, an acquisition.
And if your tech realistically needs 15 or 20 years to mature and reach its full potential, that mismatch is a killer. It means really valuable strategic IP can get stuck, underfunded, or pushed towards premature, suboptimal commercialization just to satisfy the funding model.
So what's the alternative structure for financing these marathon innovations?
The core idea is the perpetual R&D trust. It's a different legal and financial vehicle. You take a specific, valuable IP estate, maybe all the patents around quantum-safe storage from a research lab, and you aggregate it into this trust.
Okay, so the IP lives in the trust. Then what?
The trust then issues royalty-backed notes to investors.
Notes, not equity.
Exactly. Investors aren't buying a piece of a company hoping for an exit. They're buying a right to the future income stream generated by licensing that underlying technology.
And who licenses this kind of long-term tech?
Instead of aiming for a broad market initially, these trusts often focus on direct-to-sovereign licensing. They'll license the whole technology bundle directly to, say, government defense agencies or maybe critical infrastructure operators under multi-year, large-scale procurement contracts.
That sounds potentially much more stable for everyone involved. What about the inventors, the scientists? Do they lose control?
No, and that's key. This structure avoids equity dilution. The original inventors often retain significant control, often through board seats or advisory roles within the trust, and the investors. They start getting quarterly royalty distributions as soon as those big licensing deals start paying. No waiting for some distant exit event.
Predictable yield from the get-go, almost. How do you keep the R&D relevant over, say, 10, 15 years? Needs change.
Governance is absolutely vital here. These trusts are typically overseen by industrial trust networks. These aren't just passive boards. They usually include both the original technical founders and representatives from the end-use clients, the government agencies, the infrastructure operators.
Ah, so the people using the tech help steer its development roadmap, keeps it aligned with real-world needs.
Exactly. It ensures the long-term R&D stays focused on strategic requirements, not just theoretical possibilities.
Okay, so let's look at the benefits again. For long-term investors, like family offices maybe, it's a source of long-duration, possibly inflation-pegged yield backed by essential tech.
Yep. For government buyers, they get access to cutting-edge innovation without needing to acquire companies, avoiding vendor lock-in sometimes.
And for the innovators, this sounds like the dream.
It really can be. Freedom from the constant fundraising grind. They can focus on the deep technical work, knowing there's a stable, long-term funding path tied directly to the use and impact of their creation.
Give us a scenario for this one.
Okay. Imagine a research group holds, say, 40 key patents related to autonomous self-healing encryption for data storage. Super strategic stuff.
Instead of forming Quantum Store Inc. and hitting Sand Hill Road.
Right. Instead, they transfer that whole IP portfolio into a perpetual royalty trust. That trust then negotiates a 10-year, maybe $120 million licensing deal with several allied nations' cyber defense agencies.
Okay, big contract secured. How does money flow?
The trust then issues, let's say, $60 million worth of these royalty notes. Maybe insurance funds pick them up, looking for that stable, long-duration yield. Within 18 months, maybe sooner, those note holders start getting their first quarterly payments from the licensing revenue.
And the inventors.
They likely have seats on the trust's advisory board, maybe majority voting control on key technical decisions. No equity changes hands, no pressure to sell the company. They stay focused on evolving the technology to meet the defense agency's needs over that 10-year contract and beyond.
It really is a complete paradigm shift for funding deep strategic tech.
Yeah.
Okay, so as we wrap up this deep dive, what's the single biggest takeaway for C-suite leaders listening today, especially those feeling the heat from AI and, this changing landscape?
I think the fundamental message is this. Your durable competitive advantage going forward, it's going to be built less on just having better information and more on operational leverage and genuinely new business architectures.
Indeed.
Meaning that physical infrastructure you have, the complexities in biology you might be exploring, even those patents sitting gathering dust. These aren't just costs or background assets anymore. They are potentially powerful engines for generating significant independent cash flow if you structure things differently.
So just trying to sell more software licenses or hoping for the next big VC round? That might not be the most resilient strategy in this post-GPT world we're entering.
Probably not. The real winners, we think, will be those who master the pivot, pivoting from just selling data to guaranteeing real-world performance, pivoting from slow, discrete discovery to accelerating the velocity of biological insight, pivoting from chasing exits to compounding intellectual property value through perpetual innovation vehicles.
Mastering uptime, discovery velocity, and perpetual innovation. Those sound like the new pillars.
They really could be. Those are the paths to building durable advantage when technology is shifting the ground beneath your feet so quickly.
Definitely a lot for executives to think about as they steer their organizations. Thanks for unpacking these models.
My pleasure. And maybe a final thought for you, the listener, leading your teams. Look around inside your own organization. Where are your dormant assets? Where is the untapped physical capacity, the biological data, the underused IP? Ask yourself, could one of these models transform that from a cost into a cash generating engine, independent of the old ways? That's the homework.